Good evening, traders and investors. Will back here with another one, coming to you with a weekly market recap. I'm filming this video on a Saturday evening, so hope all of you are having a very good weekend so far. And we're going to talk about Friday's action, of course, in which we saw the markets tumble some of their biggest amounts that we've had since the month of May. And of course, as you all know by now, it was due to a lackluster jobs report and some revisions to previous jobs reports that showed that the labor market was a bit weaker than previously anticipated. Now, although the news may come as a surprise to you guys, the move from the markets probably did not. Over the past few weeks, we've been talking about the fact that markets were quite extended. We were in overbought conditions on the S&P. We also had the end of July seasonality, in which we knew that July was one of the best months of the year. And thereafter, into the fall, we could find a little bit of choppiness. Thereafter as well, we had some conditions where previously, in the past few weeks, we had been extended into the greed and extreme greed categories. Essentially, what I'm trying to say here is there was always going to be a reason for the pullback. The markets don't just pull back on their own. The markets are not alive. They're not their own entity. It's a byproduct of people buying and selling, of course. And of course, if you want to have the markets come down in a significant fashion, aka trigger meaningful selling, well, you have to give people a reason to sell. And people usually don't sell on some soft headlines. You need something big to create the stir, create the narrative, a spark to a flame type of thing. And that's exactly what we got on the Friday session. So in today's video, we're going to try to make sense of it all. Number one, we're going to cover the jobs report and my thoughts on the whole matter. Is the jobs market deteriorating at a rapid pace? Are we going into a recession? Is the S&P going to tumble to April levels? Or is it maybe just a bit of an overreaction and some very healthy price action? We'll take a look at that in today's video. Number two, we have a few earnings reports prepared for you guys. So we're going to be going over three companies. Number one, we're going to take a look at Reddit, which had earnings on Thursday. The stock jumping almost 20% towards the highs. Thereafter, we're going to take a look at Booking.com, a nice insight into the consumer. And on that same day, although they were not on this list right here, we'll be taking a look at S&P Global, one of my favorite companies in the entire stock market, just to give you guys an idea as to why this company is so loved by institutions and why I really think it could be a nice backbone to every single portfolio out there as well. So we'll be covering those three earnings in today's video. Thereafter, we will be going over some technicals because we got a lot of charts to look at, guys, because we have broken some very key indicators here, which could lead us to believe that maybe it's not just going to be a one-day drop. There could be some follow through, and as a result, I'll take you through some levels that I'm looking at across all of our major indexes. Thereafter, we're going to do the same thing on big tech, this infamous big tech list that we have right here, and other companies as well. Since we might know that, and we might anticipate that the markets will be dropping for more than one day, where can we possibly see some support now that a lot of these stocks are coming down and coming down hard? Where are the next levels of interest, either for some swing trade longs or possibly some long-term portfolio buys as well? After we're done that big tech list, we will do the exact same thing. This time, however, going through the biggest gainers and losers of the day on Friday, of which there were many losers. So we'll take a look at some of these companies that were down 6, 7, 8, 9, 10%, derive if there's any swing trade opportunities there, and also take a look at some of the biggest gainers of the day, because yes, there were a few, and there was some healthy rotation to be had in the markets if you knew where to look. That's going to be it for today's video, guys. Hopefully you guys enjoy. Let's jump right into the action right away, shall we? So the SPY down 1.64, the Q's down 1.97, and all across the board, it was a pretty bloody day. Take a look at the heat map right here, and you'll see that a lot of the selling was concentrated into growth and tech, some of the categories that had been our market leaders over the course of the past 1, 2, 3 months. And I'd been saying over the course of the past 2 weeks, especially in relation to semiconductors, they were your lead bull. When you lose your lead bull and that goes into a daily downtrend, pay attention, because that will also lead to the indexes going into big consolidation as well. When you lose your lead bull, guys, suffice to say, you are probably going into something more than just one day's worth of consolidation, but that is where most of the pain was to be had. Financials, the banks had been having a tremendous quarter so far. They had been running very extended from a lot of their moving averages. Now, some healthy pullbacks. The banks pulling back multiple percentage points, and the credit card players too. And I'll remind you, this entire sector had very good earnings. We know that this season so far, earnings price action has been, to use the word, it's been garbage, to be honest with you guys. Companies have been reporting very decent numbers, but we have been noticing that unless it was a true blowout quarter like we saw from the likes of Microsoft and Meta, people weren't really getting much love. If they were just coming in line with the expectations, raising guidance a little bit, really not knocking the socks off of Wall Street analysts' estimations, right? If that was the case, those companies were coming down. That is also a sign that a market is getting a little bit too extended to the top and struggling to find some buyers, even with some good fundamental reports. Healthcare had a decent little day of recovery, some pharmaceutical companies coming back, and consumer defensives also saw some rotation. So essentially what you saw on Friday is a rotation out of growth and into some sectors which have been lagging behind the market in terms of recent memory, talking about the last 30 to 60 days. The bottom half of the market, though, industrials, real estate, utilities, and energy, a bit of a mixed bag. And even though we saw rates, especially the 10 and 20-year yields, collapse on the Friday session because we have increased probabilities of a rate cut in September now because of the jobs report, still not much love to be had in these sectors overall. It was, for all intents and purposes, a very bad day for the markets. Take a look at the one-day relative. You'll see that even better. Only defensives and healthcare making it out alive. Everything else down, and down sometimes multiple percentage points. On the 1 week relative, we'd been noticing the weakness starting into the week, and we were supposed to have some big tech earnings that were fantastic and might just save some of the green that was previously on these one week relative performance charts. That didn't happen. Amazon had some pretty good earnings. We take a look at them on the channel, and sadly, the market just sold them off anyways. Apple had some pretty good earnings. Matter of fact, the best that they've had, arguably in the last 3 years. Market didn't care, sold them off as well. And even Microsoft and Meta, which had really good earnings, since they released their earnings, they've been nothing but down, taking profit. Wall Street possibly trapping the last of the FOMO buyers at the top and selling down. On the 1 month relative, even though the month of July was very good, you can see what a bifurcated market it actually was. A lot of the movement to the upside was led by a few key sectors. Utilities is small, but they had the best gain. It was really only tech and communication services. Communication services, I'll remind you, is largely led by Google and Meta. So in the month of July, we had some very good performance. We covered that on the channel when we recap the monthly candle closes into the Thursday session. But we also noticed that the breadth was kind of lacking towards the end of the month, and that we would not be surprised if we had any negative catalyst that would be the precursor to kind of ignite a little bit of a downtrend and pretty much give us some much needed consolidation after such a beautiful month. 4 or 5 weeks of green in a row, it might just be the time to cool off a little bit, and that jobs report provides all of the juice, all of the ingredients for an extended market sell-off. I'm not saying crash, I'm not saying correction, but when you're looking for something that could bring down the markets for more than just one day, well, weaker than expected jobs reports and the whole narrative that gets constructed around that, talking about media is going to be talking about, the possibilities of a recession, is the Fed too late? All of those ingredients are going to be quite sticky, and the damage might just not be able to be undone in one single day. So hopefully you guys have been listening to the non-financial advice that I've been giving on the channel of taking some profits into these highs. You had a lot of different things that were showing that you were getting quite extended on the markets, and we were saying that any bad piece of news, they were going to run with it and they were going to sell it off, and that is exactly what happened. Now let's jump into the jobs report and see whether it is as bad as people are currently talking about right now. So if we take a look at the numbers really quickly, guys, in terms of the non-farm payrolls, you can see here that it came in at 73,000 versus the 110 expected. Now that is better than last month's report, but still far under the expectations. However, we do have a silver lining here. It is average hourly earnings. I'll remind you that the overall inflation right now is sitting about 2.5, 2.6%. As long as your average hourly earnings on a year-over-year comparison basis are growing faster than the rate of inflation, consumers are regaining purchasing power. So you might see some jobs numbers like this and think, oh no, the economy's falling off a cliff, the unemployment rate must be rising. As a matter of fact, no, it's not. 4.2% is the unemployment rate right now, still the same as it was last month. And in terms of historical context, 4.2 is still a very low number. So although the amount of jobs that we're adding is getting lower and lower, are people necessarily losing their jobs? Are corporations firing people? And are there a lack of jobs available in the economy right now? As a matter of fact, the answer to those questions is no. Jolt job openings on the Tuesday session show that there are still 7.4 million jobs in the economy to be had, and currently people who have their jobs are still employed. The companies are not necessarily firing anybody right now, and we just had most of the earnings for the season pretty much. You can see that from this right here. We've just had a few very large weeks of earnings, and we did not hear any indication that these companies were struggling to maintain profits, struggling to maintain EPS, and as a result, firing their employees. Matter of fact, we heard just the opposite. We heard the consumer is still solid, that they are still having the consumer still is fully employed. We heard that from the banks and from the credit card companies, and as a result is still spending money. They are still very carefully choosing what to spend their money on, but they are still fully employed and are still, relatively strong, and they're regaining purchasing power against the rate of inflation somewhat slowly. We also got some indications from ISM manufacturing prices paid that it came in well below the expectation of 70. And that's actually good. It shows that the tariffs are not quite affecting manufacturers just yet. And matter of fact, we can reiterate what we've been hearing from so many earnings reports, unless, of course, you take into consideration the car manufacturers such as Ford and GM, who have a number of tariffs, steel, aluminum, parts, stuff like that, right? But other companies really have not so much been affected by the tariffs just yet. All in all, when you take a holistic view at the markets, guys, there aren't any crazy red flags out there in terms of earnings per shares having some downward revisions. As a matter of fact, I showed you guys some statistics on Thursday that showed that of all the companies that have reported in earnings so far, many of them, actually 3/4 or better, 78% of companies are beating the EPS estimates, and over 85% of companies are beating revenue estimates and are maintaining guidance for the rest of the year. So we don't have any red flags from the corporations themselves. However, this headline number right here and the revisions is enough to spook markets into taking profits and into some consolidation that we have not had for a while at this current stage. So the table is set, and now you've had your catalyst for some consolidation. Let's deep dive these numbers and take a look at exactly what happened. So the US added just 73,000 jobs in July, and numbers for prior months were revised much lower. Non-farm payrolls growth totaled 73K for July, above the June total of 14, but below the estimate of 100K, which was what we talked about before. June and May totals were revised sharply lower, down by a combined 258,000 jobs from previously announced levels. These are the largest revisions that we've had in over a decade, especially to the downside. The week report, including the dramatic revisions, could provide incentive for the Federal Reserve to lower interest rates when it meets next September. Curious. After Jerome Powell's meeting on the Wednesday session, these rate odds plummeted from 65% chance, 69% chances of a cut in the most recent few weeks. In September, they went down to 45% chances of September being a rate cut month for the Fed. And now you can see what happened. After that jobs report, we have the probabilities of a September rate cut coming in at over 80%. So now the Fed is going to run out of excuses to leave the rates high, and most likely we will be getting our 2, possibly even 3 rate cuts by the end of the year. So you might think that this could be something good for the markets, right? Why are the markets reacting negatively if the end result will be rate cuts when the market wanted them? Well, as I said, guys, it is the first negative catalyst that you've had in quite a long time. So of course, there's going to be some initial fears and concerns over that before the market is able to kind of make some sense of it and price everything in. So let's move on here. You'll see the monthly job creation in the US, some of the lowest figures. Well, on Friday rather, we got 73K, but look at these low numbers for May and June, those revisions. As a matter of fact, of course, I know a lot of you are going to ask the question, is he going to talk about the person in charge of these statistics at the BLS being fired by Trump and being replaced by somebody? Yes, guys, but it doesn't matter, right? Which is not why I'm not going to get into the politics of it. It doesn't matter who's preparing the numbers. You can say the numbers are rigged. You can say the numbers are fine. It doesn't matter. They are what they are at this current stage, and the market will react to that. The market is not going to start pricing in, are the jobs numbers rigged? Are they not? What you're seeing here is a clear decline in the labor market, not to relatively unhealthy levels. There's still a lot of jobs in the economy. People aren't getting fired, but the amount of jobs that are getting added is just getting lower and lower and lower. That portion of the labor market is eroding, but we are still very close to maximum employment. But you can see a clear trend, right? Even if these numbers were not revised, you could still see a very clear trend towards the downside. This is what one analyst had to say. This is a game changer jobs report. The labor market is deteriorating quickly. But as we went through all the other statistics, right, we can clearly see that no, it's not really deteriorating quickly. One aspect of adding new jobs to the economy somewhat is deteriorating from prior levels. This is true, but is everything deteriorating rapidly? Are people losing their jobs by the millions? Is the unemployment rate skyrocketing? Are there no jobs available in the economy? No, the jolt still shows that there's over 7.5 million jobs in the economy. The unemployment rate is still stable, but the amount of new jobs that are getting added, that is what's deteriorating. But you will start, the reason I highlight it is you're going to have to start being able, guys, to see through these narratives, okay? Because for the next couple weeks, this is all that they're going to talk about until the Fed has its meeting in September, to where supposedly they can all make this go away by just cutting interest rates. As a result, companies will hire more. This is true, but it's a long cycle, so pay attention to these narratives. You're going to get bombarded with all of these, and you have to see through them. So as a result, you will have to prepare a shopping list of your favorite companies, high-quality companies that hopefully most of which have shown tremendous earnings and maintain guidance for the end of the year. And if their company stock prices drop because the markets are consolidating, you should indeed be a buyer. You are buying these companies because you are relying on their long-term fundamentals and they are able to get through these economic cycles. And you are not going to get carried away in sensationalist headlines, please, okay? That's what I want to teach you guys. The week report, including the dramatic revisions, could provide incentive for the Fed to lower interest rates when it next meets in September. Here's your unemployment rate again. And down below, we have one more chart, which is the U.S. wage growth, which I was saying, as long as this is above the rate of inflation, people are regaining purchasing power. So that is not a question here. As I said, there's only one piece of the labor market that is currently quote unquote struggling, and that is the addition of new jobs. But there's already tons of jobs out there, more than enough for the current amount of people that are unemployed, 4.2%. So those are my thoughts on the jobs market, guys. But my thoughts are not going to be enough to turn around the market. It is up to you to be able to look through these narratives, see them for what they are, simply just narratives that lead into price action, corrections, into possible weak seasonality. So you see the narrative has a lot of juice right here. They can run with it. Lower jobs, we're not going to get to hear from the Fed till September. Fall seasonality is usually choppy. The markets were in previously greedy and extreme greed territory. We were seeing the meme stocks run. You were seeing companies that had, I'll just say it for what it is, right? The nuclear sector running on no revenues whatsoever, just hype and momentum alone. You were seeing companies like Robinhood trade at, 45, 50, 60 price to sales, and now those are being unwound. You were seeing a lot of froth in the markets, guys. Don't kid yourselves, right? Eventually, when you get one bearish catalyst, all of that will get unwound quite quickly, and then we will resume, right? We will find a local bottom, similar to the last time we had a narrative in the markets, the tariff narrative, and then we will find local bottoms, the price will normalize, you will find equilibrium, and then we will move on to something different into the late fall seasonality and early Q4, and you will have to rely on companies' fundamentals. They've already told you this quarter that the guidance was maintained for the year, and many of these companies did raise their guidance. Their price action might have not been very bullish. Shout out to ASML, shout out to Micron, shout out to TSMC, shout out to other companies such as Amazon and even Google and other companies that had great earnings, but for some which reason, the market sold them off anyways. But they did give good guidance for the end of the year. It's now your job to build that shopping list of all these solid companies. And if they come down because of a narrative and a sentiment in the market, it is your job to buy that sentiment and call out that bluff and invest in high quality companies. So I did a very long introduction here, but I think it was much needed because this is, stuff that people don't usually talk about too much, right? They'll just give you the numbers and they'll see the sky is falling, but you won't be able to read between the lines and use the price action. We've been waiting for a correction. We know the bulls are in control. You need to use the narrative, use the relevant time horizons that you think that it might last, and thereafter build some trading positions, or possibly build some long-term positions that you're going to be looking to shop for, and be patient. Let the market come to you, okay? So that is a very long-winded introduction, but hopefully you guys enjoyed it. I always do this as soon as I feel that there's a narrative started. We spent a lot of time discussing tariffs and the strategies that we're going to move into them. Now is the exact same thing. Build the shopping list. If you are a long-term investor and you don't trade, it's very simple. Every single paycheck, 10% of your paycheck minimum should be invested in the markets for your long-term future. You should enjoy these dips. Everybody's been saying there's no deals in the market. Everything's ran too much. I wish the markets would just crash. Yeah, well, now they're going to come down, but don't get carried in the narrative thinking, oh no, I'll just wait until it drops X amount, Y amount, Z amount, 10, 15, 20%. Just start buying the dip, DCA with your paychecks, and everything's going to be fine. If you are trading, you'll want to pay attention to the levels that I'll be giving you in, roughly about 20, 30 minutes when we get through these earnings presentations. Talking about those earnings presentations, let's get to them right away, shall we? So we are first going to cover Booking.com, an extremely high quality travel company right here. And the reason that I do this one is because we want insights into the consumer. We know that for the past 2-3 years, consumers have not been buying things, they've been buying experiences. And you need look no further than some earnings from your electronics companies, such as Apple, who have had very weak sales for the past 2-3 years. But not only them, Microsoft, NVIDIA, AMD, talking about the consumer segments of those businesses. They've been very weak. People bought all the things that they wanted to with free money and stimulus checks and low interest rates in 2021 and 2022. And now they've been focusing on experiences since they bought all they wanted to buy. So now it's time to travel. And is that travel still healthy? Well, let's have a look here. Booking.com, unfortunately, unwinding throughout the week, but it's not because they had bad earnings. Matter of fact, they absolutely crushed it and did say that travel was resilient. Now, we got a 10% beat on EPS. We got a 3.74 beat on revenue, which is very solid numbers overall. But the commentary from management was also quite good. Take a look at some numbers here from Booking.com, and we'll see exactly what we're talking about. So in terms of the numbers, guys, very healthy. Room nights, 8% year over year. That is very strong. Gross bookings, 13% year over year beat. Very strong. Revenue up 16% year over year. That is fantastic. Now, we did have a slight decline here on net income and a slight decline on GAAP EPS. Those are one-time charges of the company looking to expand infrastructure to, well, the company, I mean, it doesn't have very much infrastructure, right? But it does modernize its servers and stuff like that. So there are a few one-time charges, of which I'll spare you the details, but just know that the non-GAAP, meaning if you were to remove the impact of these one-time items, the numbers were actually pretty good in terms of EPS, as you saw from this non-GAAP EPS beat right here. Fantastic earnings beat here by about 10%. So, you got to kind of look through that as well. Free cash flow, extremely solid at $3.1 billion. And this is a company that just is a free cash flow monster. They make very decent net margins, and they do bring in a ton of free cash flow as well. Now, in terms of the expense profile, total operating expenses increased 14%, slower than the 16% growth in revenue. That's good. You want to see a company able to grow revenues faster than expenses. It means that the profit margins will improve over time. Now, Booking.com, guys, in terms of the market share, this is the company that has the most amount of market share of anybody. Here is Booking's market share relative to its competitors as of the most recent quarter. This is compiled by CSI Market, which have very good data points. So you can see here that Booking.com takes the cake, 35.25% in the travel niche, followed closely by Expedia at 19.43%. Well, not closely, but they're second place. The Booking.com by far the market leader, and Airbnb only at 15.82. But I'll remind you, Airbnb does not do flights nor rental cars. They might be doing those soon, but still, right? You can get the gist of things. Booking.com largely walking away with that prize right there. So looking quite strong, all things considered. Now, we also had a number of buybacks, buying back $1.3 billion in stock during the quarter, with a remaining authorization of $24.6 billion. That is massive, guys. $24.6 billion is 14% of the company's entire stock float. That is authorized for the next 2 years, looking very solid. And what do they do? The free cash flow that they generate, very strong free cash flow profile. Well, that's what they do essentially. They just buy back shares and buy back shares. This company is an absolute buyback monster. If you just take a look at this chart right here, I'll show you what I mean. Absolute buyback monster, and the buybacks will continue. As I said, almost $25 billion to keep buying the dip on their stock. Now, in terms of their various lines of business, guys, all lines of business are doing very well. Merchant revenues, the columns in blue, also very nice growth here, especially for the few years after the pandemic, really becoming their largest line of business. The agency revenue, because yes, they run a lot of agency services, third-party services that run through them in terms of travel agents and other online providers do use their quotes and do book through third parties using the Booking.com, the back-end software, the back-end pricing power that is obviously used, but it's becoming a lesser and lesser extent of their business. Merchant revenues are really accelerating, and that's an accretive part to the business. They do make more money on that side of the business overall. And then we have advertising and other revenue, since they have so many clients that go on their websites. But not only Booking.com, guys. Booking.com owns a number of different travel websites that you may well know. Agoda, Priceline, just to name a few. You can see that their advertising services are net higher in terms of their experiences. So we can see here room nights total from the pandemic, largely recovering that pre-pandemic trend up and to the right every single year. Rental car days, although although it's a smaller portion of the business, that is also coming back to pre-pandemic levels. Very nice there. That is the bar in orange, and the bars in purple down here, airline tickets, a smaller portion of the business, but you can see they've been doing a good job of ramping that up overall. So very nice to see that all lines of business for Booking.com are performing well. And now in terms of the outlook, guys, right? In terms of the outlook, they actually raised several segments of their guidance. Room nights growth will still be very healthy. Gross bookings growth still high single digits, which is very good. And overall, we have revenue growth in the business of between 7 to 9%, which is standard for the company. So business as usual for this company. Now, what did they have to say about the status of the consumer? That should be your next thing that you would want to know. Inbound travel. So these are the only things they had to say about the consumer right here, yeah? So global travel demand showed steady growth. Room nights, as we said, almost 10% year over year, driven by strong performance in Europe and Asia. However, the US market exhibited softer demand and cautious consumer spending patterns, suggesting economic sensitivity amongst US travelers. But not only for US travelers that are traveling within the United States, we also know that people from the outside have been hesitating to go to the United States as part of some sort of a boycott surrounding the whole tariff situation and a lot of other things like that. So inbound travel to the US declined, particularly from Canada and to a lesser extent from Europe, potentially influenced by macroeconomic uncertainties, geopolitical factors, and or trade-related concerns such as tariffs. In contrast, travel corridors like Canada to Mexico and Europe to Asia saw strong growth, highlighting the benefit of Booking's globally diversified business. This is a very nice way of saying, well, Booking.com is not so much affected by the fact that people are substituting their trips to the US in favor of other destinations. Why? Well, because Booking gets that business anyway. If you cancel a trip, if you're a Canadian, you cancel a trip to the US and book it to Mexico instead, well, Booking is going to realize that revenue as well. It sucks for hotels and travel destinations inside of the US, but that's not what Booking is measured on. They're just measured on total trips. If you substitute your trip from or to the United States and you choose to go somewhere else, Booking saying that they are getting that business as well. As a result, that is not affecting their business model. In the US, there is evidence of a bifurcated economy. Higher income consumers are spending more on premium experiences, such as 5-star hotels and international travel to Europe, despite higher costs due to exchange rates. Lower star rated hotels, however, are seeing weaker demand, indicating budget conscious behavior among some segments. So that being said, guys, the same thing that a lot of other people have been saying, right? Like American Express and like the airlines, the high middle class to the luxury consumer, they're still very strong. What's really struggling is that the lower element of the consumer, right, in terms of lower middle class to low income classes, well, unfortunately, they are not spending as much money as they once were because they're probably saving as inflation has been quite high. So Booking.com not noticing a significant decline in sales whatsoever. Matter of fact, they actually raised their guidance. Booking raised its full year guidance, expecting low double-digit growth in gross bookings and revenue, reflecting optimism about resilient travel demand. So they're saying, yes, there's a few items here and there, but overall the business is still strong and people still do enjoy traveling. Where did we hear that recently, guys? From Visa and MasterCard, cross-border transactions. People who have cards from the US and Canada, they're using those credit cards abroad. So that's telling those companies that people are still traveling and travel demand is faring to be quite resilient, especially in relation to other consumption goods, right? So it's still all about the services economy for most people out there and preferring to spend money on experiences rather than goods. So all that considered, guys, is Booking.com a good investment? Now that we're down into the $5,300 range, is Booking.com a fair investment? Well, as a matter of fact, I do think so, guys. At $5,350, you're looking at a forward price to earnings of 24.08 and a PEG ratio, a very manageable PEG ratio of 1.6 with a beautiful free cash flow yield of 5.27%. Now, you might think that Booking.com is very close to the highs. It can't be a good deal. Well, guys, that's why I never say don't base your judgment if a company is a good deal or not on the chart and how close it is to the all-time highs. Sure, you want more of a discount than not, but still, objectively, is Booking a good buy? Yes, this is a very, very high quality company with overall very good margins, talking about in the mid, teens to 20% range, depending on the quarter. It has very good growth. It is the largest player in that segment. And additionally, the company does a great job of increasing free cash flow every year, has a lot of cash on the balance sheet, not that much debt. And if you look at the consistency consistency, I mean, if we were to remove the impacts of a global pandemic, of course, it's a very consistent company, increasing EPS for shareholders every year and increasing revenue for shareholders and for their own business every year. Booking.com for me gets a buy. And if we come down here into the 5,000 area, I will be adding a few more shares as well. Definitely not one that I'm looking for massive expansion for a short-term swing trade, but as part of a long-term portfolio structure, I think this is definitely one that people can consider. That's everything for Booking.com. So hopefully you guys enjoyed that. Now let's move on to company number 2, which is going to be Reddit. So Reddit coming in with their earnings after the bell on Thursday, and they absolutely crushed it. The stock was up over 20% at the highs on Friday before retracing a little bit with the rest of the markets. However, they did maintain a large number of their gains, still up 17.5%. If you take a look at their earnings right here, guys, they absolutely crushed it. 136% beat on their EPS. But I mean, it was coming off a very low number, right? So keep that in mind. And also they had a tremendous beat on revenue, 17%. And we had some hints that this was going to happen. Number 1 was Google and number 2 was Meta. Both advertising divisions of those companies performed very well. And since Reddit makes a bulk of their revenue from advertising, well, it stands to argue, guys, if the 2 biggest social media companies, or rather, well, Google's not really a social media company, but it gets a lot of traffic, right? If 2 of the largest companies that receive most of the user traffic are saying that advertising revenues were good, well, you can probably take a hint and assume that Reddit's numbers are going to be good as well. However, they did smash it, not taking anything away from them. They did it all on their own. Take a look right here at the numbers, the easy numbers. Revenue up 78% year over year. That was fantastic. Daily average users up 21% to 110 million, which is very strong. EBITDA margins up and to the right. This company was not always as profitable. As a matter of fact, just a few quarters ago, the company was actually net negative in terms of net income, and we've been looking for that net income turnaround story to continue broadening out. You can see here that for the past 4 quarters, they've been generating some very good net margins. This quarter was the same at 17.8, so really starting to turn things around and become a more consistently profitable company. The ARPU, average revenue per user, was up 47% per year, showing that they can monetize their users a little bit more through ads and various other things. And we also had EBITDA up 323% per year, once again showing that the company is moving into operational efficiency. Let's move into some items of the article, shall we? Reddit shares jump as much as 20% on second quarter sales and guidance beat. So moving on down, 17%, the revenue number here, 78% year over year, was 17% above consensus estimates. Now, if you're looking for a blowout quarter and massive gains, this is a blowout quarter. We've only had a few of them to where everything came in wildly above the analyst estimates, and Reddit, every single metric came in wildly above the estimates. Net income came in at $89 million in the second quarter compared to a loss of $10 million in the second quarter just a year ago. The company said third quarter revenue, here's the guidance, will be in the range of $535 million to $545, ahead of the Wall Street estimates of $473. This is a 15% beat on top line revenue guidance. This is the blowout that will get you the big double-digit returns after earnings. Anything under that, guys, you know, if you were just coming in line or raising guidance by a fraction of a percent or a few percentage here, you guys know what was happening. Companies were just going down. This time, not so much. This one smashed it. Adjusted earnings in the third quarter are projected to be between 185 and 195 million, the midpoint 190, ahead of Wall Street's estimates of 160. This as well, guys, almost 20% beat on earnings guidance. So fantastic numbers and fantastic guidance from Reddit. Got to give it to them. We already talked about the average revenue per user that came in at 453, which we saw on the chart before, but it came in so much higher than the guidance, which was 3.9, guys. Fantastic. Once again, almost 15% beat on average revenue per user. So they've set the bar quite high for future quarters. Other revenue, which includes Reddit's data licensing business, because yes, they do sell your data, jumped 24% year over year to 35 million. Still a smaller component of overall revenue growth, but it is a component. Moving on further, the CEO said that in order to focus on the most pressing needs of the business, Reddit is deprioritizing a few initiatives, including its work on the user economy. Reddit's initial IPO detailed the company's efforts to build a user economy business, which would include games and online marketplaces akin to Roblox and Facebook Marketplace. So apparently they're putting that on hold and focusing on the structure of their business right now, which is really trying to deliver more revenue per user in the form of monetizing the advertising aspect of the business. So the other things, unfortunately, on hold. Now, One thing that this company struggled with in recent quarters was, of course, recent changes to Google's search. Apparently, and they had complained about this, that Google made some tweaks to search whereby Reddit was not appearing in the top search unless you kind of typed it in. Like if you had a query and you want people's opinions, Reddit is an opinion place. When you want to know something about whatever, right? You can do a few things. You can ask Google, you can ask ChatGPT, but for the most part, if you want to hear from real people about a topic, that's when you would tend to search Reddit. So here's what he had to say. Traffic from Google varies from week to week, but overall it was a headwind in Q2, said the CEO. But looking into Q3, our Q2 exit number was higher than the Q2 average of 110 million, talking about the average users that visit the website per day. Huffman acknowledged that Google's continual testing of newer generative AI-powered features, such as AI Overview, affects everybody in the ecosystem. However, the CEO pointed to Reddit's growing name recognition among consumers as helping the company withstand any major changes, saying that Reddit is one of the most searched for terms on Google because users around the internet go to Google with the intention of ending up on Reddit. As I was saying, if you want people's opinions, you will type Reddit behind your query into Google, and then you will land directly on the Reddit search results. But if you only type in a broad question without the term Reddit, maybe Reddit is kind of buried midway to the bottom end of the page. So those are the highlights from some of the trends that Reddit is facing right now. Now, of course, the question that everybody is asking is, after a 17% jump, is this company still a buy? You might remember that down here I was saying, yeah, it was looking pretty good. Nice little bull flag right here before earnings. And we also had the data from Google already. And we were kind of saying, yeah, it might not be bad for a bit of an earnings lottery. Well, that trade is now done. It's taken profit. It's over and done with. The valuation of the trade right now at $188 is sitting at a price to earnings ratio forward basis of 108. Now, that's not too bad because they're growing EPS at a wild rate of 52% per year. This eventually will be coming down as the law of large numbers will catch up to them. The PEG ratio is sitting at 2.07, so the company is not too cheap anymore. It was decently valued down here. It was fairly valued. It was even better down here when we talked about it during the tariff sell-off. But I digress. Price to sales on a forward basis is a 17, also at the top end of the range for a tech company, despite the fact they're growing revenues very nicely at 24%. They will not be able to maintain those growth rates forever. But that being said, Reddit for the next few years is looking good. EPS is steadily increasing up and to the right. But as I said, eventually the law of large numbers will catch up with them, right? And obviously revenue as well. They're having a very nice expansion phase. They will be doubling revenues from 2025 to 2028. So if we take their forward price to sales for 2028 and you just divide 34 by roughly 4 billion right there, well, you get a much more manageable price to sales ratio of something like 34.83 divided by your 4 billion. You're looking at about an 8.7 forward, but you do have to go all the way out there to achieve that valuation. So is Reddit a buy for me? Well, if we do come back down here to our support range, 173 to 153, there could be a swing trade in motion here. In terms of a long-term investment, guys, well, you guys know the deal with me and long-term investments, right? They have to have a moat. They have to be either the largest player in their segment, or they have to be such a dominant force in the market that's been that way for a decade for me to even think of putting them in a long-term portfolio for the next 10 years. Reddit, in my opinion, will have no problem growing their share price. So in the next few years, if the thesis is a 1 to 3 year time horizon, I think that you could see some very good gains on some longer term shares on Reddit. But is this a company that I would put in my long-term portfolio for 5, 10 years plus, thinking that they'll always grow at these growth rates? Probably not, right? So there's a trade here, but there is not a long-term portfolio position here for me. Unfortunately, if I'm going to go for a pure play advertising company / social media, that would have to go to either Meta and or Google for the strength of their advertising business overall. So I would rather be in Meta and Google for the long term, I'm talking about long term, than this company. But short-term gains, and when I say short-term, I don't mean in a week or something like that, over the next 2-3 years, not a bad play in my humble opinion, especially if they can keep this growth of margins up and keep monetizing their user base very well. I think Reddit does have its place in the user economy. So curious to see what this business will do in the future. That's everything for the Reddit earnings. Hopefully you guys enjoyed that one. Now, lastly, we're going to cover somewhat of a boring company, but a company that everybody should know about because the quality of this company's moat is extremely strong. This is the style of company, although it doesn't grow that fast, it is the style of company that many people do look for in their long-term portfolios. So I I figured that I'll present it once per quarter as I usually do. So SPGI, S&P Global, the company that owns the S&P 500 and owns the Dow Jones series of ETFs, but they also have a ratings business in which they have a duopoly with Moody's, they have an analytics business as well, and a couple other slight lines of businesses that would warrant your attention because it's a very well-rounded company with extremely solid fundamentals. So let's get into it. In terms of their earnings, they had earnings back here on Thursday, July 31st. They crushed it. 5% beat on EPS and a 2% beat on revenues. We expect as much from SPGI. It is somewhat of a boring company, I will admit, but an extremely solid company in its own right, being almost, guys, I mean, it's a duopoly for some things such as the indexes business. It's a duopoly with other things such as, Vanguard, BlackRock, and MSCI. There's only a few players who have very large ETF businesses. There's only a few players that have very large ratings agency businesses. The only other major one that's publicly listed, truly, is Moody's Corporation, right? So several lines of businesses for them. They're in almost monopoly status, and I love to look for this style of company in the market. Let's take a look at what their numbers delivered overall. They were very, very good. So they have a few different lines of businesses here. The index business, which I talked about, mobility, which they're actually selling off because it is one of their lines of business that has the lower profit margin. So they will be spinning off the mobility business. If you don't know what this is, they own Carfax, essentially. When you guys buy a new car or buy a used car, and you want to know if the car's been in any accidents or stuff like that, you run a Carfax search, which usually costs a couple dollars. Well, imagine a couple dollars times millions and millions of vehicles. Makes a lot of money for this business, but still, surprisingly, one of their lowest margin components. So we're going to get into that. This will be sold off, by the way, in the next 2 quarters. But indices business, up and to the right, 15% growth, very solid. Commodity Insights, so obviously being a company that has a lot of data, they will sell the data to institutions and financial firms. And you can see here an 8% bump on commodities. Ratings business, similar to Moody's, a bit flat, guys. Why? Because they re-rate everybody's debt, whether it's a government, whether it's a municipality, whether it's a corporate bond. Everybody needs to have their debt re-rated, especially if they want to issue more of that debt to public markets and to end consumers. Whether those are institutions or retails, you're going to need to have your debt re-rated. The problem is rates have been largely the same for the past year and a half. So companies have not had the need to re-rate their debt because the rates are the same. However, we are currently embarking into a rate cutting cycle. And if you remember the Moody's earnings from our other video, the timeline, 26, 27, 28, these companies have an enormous pipeline of debt that will need re-rating. And these companies make a lot of money, and it's almost free money. It's very high margin money from that re-rating cycle. So that's why I think that SPGI and Moody's can be very good plays in the next few years. You see, they've been hovering here for about a year's worth of time, doing almost nothing, but they're coming into a very large element of sales for them over the next few quarters and next few years. Market intelligence, they sell data, obviously. This is market data because they have a lot of it, and this was 5% up year over year. So every single line of business is not looking too bad. Here's the breakdown in terms of your market intelligence sector. You can see here that operating profit and expense is very good. The margins on operating margins moving higher, very nice. We already talked about the 5% revenue gain, but they break it down into a couple different instances right there. The ratings business, you can see overall it was plus 1%. Now we have, right, other, government, structured finance, corporates and stuff like that, all having different percentage ranges. But still, as I said, the bulk of the revenue here will come 26, 27, 28. So now is the time, if that's your thesis, to position in these companies. Very high margin business. As you can see, operating margins, 65.8. Commodity Insights, high margin business, 47 to 48% margins, very strong. And then we have the mobility segment, which does have, anybody would be very happy to have these types of margins, right? It is a strong margin business, but when you compare it with their ratings business, which they make a lot more money from, I'll show you, right? This is their market intelligence business. It's the blue column right there. The ratings business, which is in orange. The 2 biggest lines of business for S&P Global. Commodity Insights is purple, which has been doing good. Indices revenue is the green, which is also a very high margin business. Mobility is the one that has arguably the least amount of revenue of all 4 segments. And of the ones that have the least revenue, revenue, it is surprisingly the lowest margin business, but the margins are bad. It's just the lowest. So if they want to drive more profitability for shareholders, they're just cutting that line of business overall. Dow Jones Indices business, look at the margins on these indexes, guys. It's absolutely crazy, right? 71% margins on the business. And here's their guidance. Are they going to be doing well in the future? Absolutely. Previous guidance was raised 4 to 6, now 5 to 7. Operating profit, that was maintained. EPS, raise on EPS for the most part. Or sorry, excuse me. On GAAP, it was down but adjusted. They actually raised EPS, which is what everybody looks at, including Wall Street. So they raised guidance on EPS right here, and obviously raising the revenue guidance as well. And in terms of all the divisions, guys, some doing okay. Market intelligence the same. The ratings business, they raised the bottom end, raised the top end a little bit, which is good, 2 to 5%. But the growth in this ratings business, guys, will be much better, 26, 27, 28. And since, I'll remind you, it's one of their largest components of revenue, it's going to contribute to a lot of revenue gains here. Commodity Insights, they dropped the bottom end and the top end by about 0.5%, but that's fine. And the mobility business supposedly will be doing well. The index business was raised. Very good component as well, especially since it's high margins. So with all of that being said, guys, SPGI, fantastic company. I know it's a boring one, but stick with me here. Very high margin business. You're talking about a business that has 28 to 30% margins. Again, this quarter, 28.5. Very solid. How's their balance sheet? Their balance sheet is very good, although they have accumulated a bit more debt in recent years because of their acquisition of a company that used to be called IHS Markit. That is their data analytics business. They really expanded it. It was an accretive business decision by them, but they did increase the debt profile. But still, the debt profile is not outstanding for them. The company generates a ton of free cash flow per year and does have a decent amount of cash on the balance sheet. What do they do with that free cash flow? Well, I'm glad you asked. They buy back some shares. So here you can see the deal for IHS Markit was a combo of debt and shares. And since that deal went through, they have just been resuming their steady course of buybacks. You can clearly see what the company does with this free cash flow. Then it acquired a business, which was accretive to it because now the company is a lot bigger. And they have more of a command on the data analytics side of the market, right? And now the share buybacks are just resuming as per normal. So very strong balance sheet. And in terms of the growth, this company is one of the more predictable companies and more consistent companies in the market. You can see here that EPS, very structured up and to the right. The declines right here was, of course, because slight declines in the ratings game overall when the companies, especially when the rates went higher, they had to take a bit of a hit right there, but they're resuming the cycle. A lot of the big gains here will come 27 and 28. Revenue as well, right? 27, 28 should be very nice years for them. You can see very consistent up and to the right. A very strong company, a well-rounded company, a company that has several moats that are products of almost being monopolies within themselves. Now, is the company a buy here at the all-time high? We were talking about it here. We were talking about a few times saying that I really like this one. Now, if we get a pullback to our support area, talking about if the markets drag this one back down to the 530 to 520 range, it could be a decent add to a long-term portfolio. The company currently at about $545 per share is trading at a 31.7 forward price to earnings, which is standard for them. It's not cheap, it's not expensive, but this company does get a higher valuation from Wall Street just because its business is very consistent. It's all weather. It goes through all stages of the economy, and it only gets stronger because it has very wide moats. And also the PEG ratio at 2.34, also a little bit rich, but we can allow it because of the consistency and predictability of the business. And also the free cash flow yield here at 3.4%, not too bad. So it's not expensive, it's not cheap, but if we do get a nice little discount again, maybe it would be the time to add a few more shares. And we could tell prior resistance, all-time highs, should be future support by the bulls, and the monthly timeframes on this one look pretty good after a year worth of consolidation. This was an extended bull flag with the tariff disaster, of course. Extended bull flag might just be looking for some appreciation. So if we get a dip with the rest of the market over the next few weeks, over the next month, might just be last chance to dance for SPGI to build a position that you can gladly keep into a long-term portfolio of a company that compounds its revenues, compounds its earnings very nicely, and truly a company that you don't need to worry about. It's not like your average growth company where you're glued to the screen whenever they release earnings because you're not too sure what they're going to get. This one, kind of like Visa and MasterCard. Very powerful company, very strong moats. It's a boring company, but it's one that can have that position in a long-term portfolio. It grows very well, and it's a company that you can kind of always count on that when the market does go down overall, like a 2022 bear market, this one's not going to be left behind. They will bid it up, and it will eventually recover. So very good addition to a long-term portfolio. That's everything I had for you guys for all our earnings today. Hopefully you guys enjoyed those. Now let's dive into some charts. And we got a lot of things to talk about today, of course. Okay, so starting off with the S&P, currently embarking in some corrective action right now. You look at this chart, and if you watch my recent videos, one thing should be notable to you, and that is, of course, the loss of the 12 EMA on the daily, which, for the most part, we've been riding for the better part of the last 3 months. A few notable things: the largest decline since the early stages of the month of May. We also have lost the daily the daily 12 EMA right there, and we are also coming dangerously close to flushing our daily higher lows. As a result, when you have a big engulfing move by the bears like this, the logical assumption is maybe for a lower high, if we get a bounce into lower low and convert into a daily downtrend, that will be the first time that we've had a daily downtrend, guys, since the tariff sell-off. So it has to be notable to you. A few things are firing off things that this time is different. It may not just be a one-day pullback. You may be in for extended weekly consolidation overall. We had a very nice monthly candle close in July. We know that seasonality is not favoring us coming into this month. And we know now that there is a strong narrative at play. It's not just a one-day narrative. The narrative that the jobs are falling off is not going to be solved in one day. So you could see some relief buyers step in right here. I'll remind you, though, this 12 EMA is going to be acting as resistance, and you might just get the infamous rollover. If you flush this daily, you are losing the uptrend, and you open the door once again for the lower high into lower low. But that's okay, because who's in control of the longer-term timeframes? It is your weekly bulls. Not looking too bad right here. We have been looking for something, a spark, to cause a flame and to cause a sell-off that might bring us back down into logical areas, such as the prior resistance highs, which will now be current support for the bulls, looking between 610 and 600 to possibly make that happen as a first fallback zone. And then we'll see what we can do coming into the end stages of August, but we're not going to predict that right away. All we're looking for here, though, is the bulls to find a little bit of a base of support into prior resistance. Now, another thing that we're going to keep a look at is what is retail doing and what are the institutions doing? I bring this up every time there are some structural changes in the market, such as the price action we've just seen. Smart and dumb money, right? This is the confidence chart. You could also interpret it as to how much are people willing to deploy money, whether it's retail or whether it's smart money. Now, one thing that I do want to bring your attention, guys, is the fact that retail throughout this I just want you guys to focus on direction, right? When the markets are rallying, what is retail doing? Retail is buying, thinking that they're missing out, having absolute FOMO. They were not, however, buying down here. As a matter of fact, they were panicking and selling everything during the tariff sell-off. Then they felt the need to catch up really, really quickly and continuously bought the highs despite several indications that we were getting into overbought conditions. That's fine. What were the institutions doing? Well, you will see that institutions bought the dip so hard that they were massively overbought. And then when we started to rally into this entire move, what were they doing? Well, they were selling, offloading to retail, saying, thank you guys, sure, buy my shares, no problem at all. Now, where do we stand? Well, now retail is panicking once again, thinking that the entire sky is falling. Oh no, we have to offload our positions. Maybe some of them were bought high. We had FOMO, we're unwinding. A few smart people were, offloading positions in the last few weeks leading into this session right here, understanding all these common themes. And now institutions, the only thing you need to understand is they have a ton of buying power, but as of most recently, the last little downtick here, the past few days, they started to buy a little bit, but institutions buy not at the same speed as retail. It takes a long time, guys, to deploy billions and billions and billions of dollars into the market, right? They're not like retail where they move super fast and super nimble. They do things relatively slowly. So keep that in mind. Institutions have a lot of buying power for this narrative dip. And as a result, they probably will be buying as retail continues to panic. So as a result, guys, be institutional. Try to focus yourself on the same mindset. When you're rallying, stop feeling FOMO, stop being greedy. You should be looking to take profits, not on your long-term shares, but any swing trades accumulated from the bottom. When you start to see the meme stocks run again, when you start to see companies with barely any revenue running very strong, when you see companies like Robinhood 2x in a single month or a month and a half, that's when you kind of know, right? Maybe I should take some stuff off the table. So keep that in mind. Institutions have a lot of buying power, but they won't, right? We're not looking for something like this. they might just support us slowly because especially after this weekend, when retail understands what's happening, they'll keep selling, right? They'll just be sold into the narrative that the media will sell to them over the next few weeks. And that is just how the game is played. We can take a look at some momentum indicators as well. Percentage of stocks above their 20-day EMA. We are now coming down here in just 1 week. We went from healthy to oversold essentially on the short-term momentum. Percentage of stocks above their 20-day EMAs. Is it a good time to start buying like the institutions throughout this fear dip? Yeah, as a matter of fact, if you look at this chart, if I just put it on the monthly here, this is data from 2002. Has it been a good opportunity to start buying down here? It doesn't mean that it's going to, it doesn't mean that the markets are done selling off, but should we be looking for buys on our favorite stocks and starting to nibble as they come down 6, 7, 8, 10% in one single day and do it for, a few weeks, right? We're going to have choppy back and forth. All I'm here to say, guys, prepare the buys. This short-term indicator is definitely in buy territory. Percentage of stocks above their 50-day EMA. We have now lost the institutional line of support, which is usually the 50 percentile range. If you have under 50% of the stocks above their 50-day moving average, it usually tends to indicate that, the bears are starting to be more and more in control of the short, but also medium-term timeframes, and those take a while to turn around, often not in one single day. If this continues to deteriorate, you may find even better deals in the market, as we do know that historically, has it been a good opportunity when some of your momentum indicators are flashing in the red down here? Yes, it has. Pay attention to this. And percentage of stocks above their 200-day moving average, this never really got that high. And we were making a note of this as well, to where several segments of the market were not participating. Shout out to staples, anything consumer, and anything healthcare as well. So the market was kind of running on half of a tank of gas. And now, sadly, well, you're kind of unwinding this. But percentage of stocks above their 200, if we fall below 40 again, it does represent a good buying opportunity overall for the market. But you do have to buy slowly. Buy slowly, not all at once, because what I'm not here to do is to predict, yes, absolutely, we are going to stop here and only have a top to bottom correction on the SPY of roughly 5 to 6%. If they want to, this could be the first level, and then we can jump into more seasonality as we move on through the months of August and September. We know it's going to be choppy and unfavorable, and that this narrative can last into the next rate cut, right? So keep that in mind. You'll want to be buying some here, and then the next batch of longs, you should kind of prime yourself for down here, 583 to 575, which would be indeed a 7 to 10% correction on the S&P. I'm not saying it's going there. I'm just saying you should be prepared with your money ready for either of these two locations. If you're not buying the SPY, you should use the SPY as a proxy for individual companies. If the SPY drops 5 to 7, you know that big tech is going to be roughly 10% off their highs. If the SPY drops 10, you know that big tech is going to be roughly 15, 20% off their highs. So plan your trades accordingly in terms of either selling puts at certain levels or in terms of also loading up leaps. I'm a firm believer that if we do get this fall correction, which would look all too natural on the S&P and the Qs, just looking for a monthly higher low with the bulls fully in control right now, right? Just looking for a healthy higher low. I'm a firm believer, especially since 2026 is probably going to be a very good year for the markets. I'm a firm believer that this dip coming up right here, if it lasts multiple weeks or the next month or two, choppy, might just be the last buying opportunity for some leaps on some companies that you've been patiently waiting for. You've been waiting for the dip. Maybe the last time to load up for 2027 leaps, because I always put 1.5 to 2 years of time on my leaps just to avoid any short-term choppiness. So keep that in mind. On to the Qs right now. So I did all the analysis on the SPY. We're going to get through the rest quickly, yeah? QQQs, same concept. What happened recently? Your higher lows that were there, 558, well, they just got flushed. You are now no longer in a daily uptrend, and you no longer have the 12 EMA. Two things that have not happened since the month of May, all the way back here. Loss of the 12 and loss of the daily uptrend, that needs to be notable to you. Something has changed, and you have a lasting narrative here that might not be able to be solved in one single day. As a result, if you want to have a bias, well, the bias would be that short-term bears are taking some control. Maybe more retail and some institutions will be selling off some of their profits heading into seasonality. As a result, maybe one of the more likely scenarios, because nothing is ever for sure, right? But maybe as to where before it was 60-40 odds continuation for bulls, maybe now it's 60-40 odds continuation for the bears. Yeah, it's been a while since we've got weekly consolidation, so pay attention to that. Anything above 523 looking for a weekly higher low, coming down into your 12 weekly EMA and previously established all-time high resistance, which will now be support. This is an area where the bulls will probably find some buyers. How quickly they're able to either V-shape or two-step recover process or just tighten up, that we don't know. But one thing's for sure, if we do come down here, guys, it should trigger some buys from institutions and probably even from you guys as well if you're looking at individual companies. So please keep that in mind. One thing that I will never do on the channel is try to predict, yep, the drop is only ever going to stop there. Yep, the drop is going to absolutely go down here. We take it one day at a time and we pace our buys accordingly. The same thing that we did down there, the same thing that we did here, the same thing that we did there in that April drop as well, right? It's one thing to call out the bluff of a narrative, that's fine, but don't call it out all at one price. Pace your buys and spread things out. Moving on to XLF financials right now. Financials cutting the weekly lows as well. So take a look here at financials, clearly falling off a cliff, right? Beautiful engulfing rally. This was a daily downtrend. Nice move by the bulls. They tried to reset the trend, couldn't get it done. Engulfing move by the bears opens up the door for the lower high on the gap fill to possibly lower low or just consolidation in this range. We have also now slightly lost our weekly lows. So we'll see if the bulls can keep it up right there. But if they don't, guys, if we get the absolute flush and the downtrend, you guys know what's at stake right here. You are heading into a bit more monthly consolidation to where possibly down here 49.12 EMA, something the bulls have not really lost. Temporarily on a monthly, this was not a monthly candle close, but you can come down below it. So if you're looking for some names, guys, pay attention. The banks have ran a lot since earnings. Bank of America for me, 43.41, right? They ran a lot this entire run, maybe time for some consolidation. JP Morgan, it ran a ton, maybe some time for some consolidation, right? And many other names in financials such as Goldman Sachs, such as Morgan Stanley, they're extended from their 12 EMAs. If we get a multi-week pullback, and it doesn't mean that every day's red, it just means that it's choppy for the next few weeks with a downward bias. You might just see financials consolidate a little bit. Two of my favorite opportunities are going to be Visa. It's almost there. 12 EMA on the monthly. And MasterCard as well. Pull back to the 12 EMA on the monthly. Possibly very good locations to be building some positions over the next few days, next few weeks. You guys know the drill. Moving on to healthcare right now. Healthcare actually catching a bid on the Friday session. But however, clear weakness here. The clearest time frame for me, guys, is still the weekly. Until I see a break and close on the weekly below 130, I'm still saying that this is some form of a tightening range. Now, normally when the markets pull back and you have several sectors that have really exceeded their expectations, financials were a lead bull, semiconductors were a lead bull, and big tech also lead bulls. That money is going to need to go somewhere because, as I said, the economy and everything is not bad right now. You will see some rotation. Money will take profits on the sectors that have ran the most and possibly put it into some more defensive sectors as we move into a more defensive period in the markets, talking about this fall seasonality. So pay attention to that. I'm not ruling healthcare out just yet, but the monthly is still very clear right now, still a monthly downtrend, still trying to base ourselves into support, which was established for the last few years, and still trying to find the rounding of the bend, as this has been one that's not contributed to the S&P at all this year so far. So maybe if the money moves out of the other sectors, maybe healthcare can at least sustain rather than just completely fall apart. But we'll keep an eye on it, guys, in terms of a day-to-day basis. Moving on to semiconductors, this is your lead bull. And we've been talking about this for a while now, guys, right? What did they have this entire time? They had a daily uptrend, and they also had the 12 EMA. What did we do? Well, we lost the daily higher lows right there. So you lost the uptrend. You have not set in motion the downtrend just yet. That will be lower high, lower low. What you did do is you flushed the daily higher low, you unwound the uptrend, and you also lost the 12 EMA in a significant fashion. Two things that have not happened since the bottoms of May. Keep that in mind. It has to be notable to you. If this does continue into a daily downtrend, as I've been saying for the last few weeks, rather than trying to predict the top, let the bears show you. And if they show you daily downtrend and loss of the 12, well, then you will know, yep, that's it. And we're probably heading into a bit of weekly consolidation. Now, one small little area there is 275. The next one is the 12 EMA 269. But if you ask me for the biggest one, it's down here, prior resistance. And you see it better on the SOXX, right? SOXX has already started. This is a clear daily downtrend. No new highs and daily downtrend and loss of the 12 EMA. As a result, you've just lost your lead bull. It was the lead bull, and now that lead bull is into weekly consolidation. So as a result, until it stops weekly consolidation, which will be a byproduct of regaining the daily time frame eventually, As long as this is the case, guys, do not expect any further gains in the Qs. It's just not going to happen, right? That is your lead bull right now. Moving on in, right? Looking for a weekly higher low at this point, anything above 200. And we're coming down into several key areas of support. This box right here, it should actually be a bit wider. It's a very wide level. You can see price action stemming from the 235 down to about 215 area. This 20-point range, very choppy, a very choppy area. In my opinion, the bulls are going to find some support here, but it may just be a bumpy ride. So before calling this the bottom, or this the bottom, or this the bottom, how about you wait for the bulls to show you when they're done, or when the bears are done, by establishing a new daily uptrend and then knowing that your weekly higher lows are set. But this entire time, right, what I'll be doing is selling puts on my favorite companies below the market as best as I can. Now, moving on further to the Russell down 2.04%, and that is in spite of our yields coming down in a very, very rapid fashion here. The Russell just not having it because, well, the labor market news, right? Sadly, so the Russell unwinding here as well. You are currently seeing a daily downtrend shape up right now, and the weekly just didn't even wait. That's a big sell-off, right? From the top to the bottom on the Russell, from the top of the previous move, that's already 5% plus, and we came down into this area hard. And I was saying that depending how we revisit this area, I might be interested. But the stock market is not a game of locations. Just because it comes there doesn't mean I instantly have to buy. It's how does it come down here? Too much momentum for me. What we might be looking for is kind of an unwind here of the daily uptrend into a downtrend and further weekly consolidation. So as of right now, I'm not interested in the Russell. There are many other names that will be consolidating, more high quality names in my opinion, that might be consolidating over the next few weeks. I'll be playing them instead. So once again, the Russell, unfortunately, not quite interested for me, but I understand if you are, the buys should be paced from here all the way down to the next support range, which would be 200, if ever we really unwind hard on growth, which is always an option, right? Never say never. You can see the size of these legs when they start to unwind, and you might just lose the weekly. It doesn't mean that we have to unwind everything and go down there. It just means that it could unwind a bit faster than you might expect when you are faced with a labor market narrative such as this. The bulls would just be looking for a higher low on the monthly, so they can do it here or they can do it down there. So if you want to accumulate, these would be the two ranges, but go slow. Moving into the rest of our sectors here, XLP still doing a whole lot of nothing. Whole lot of nothing, categorically, right? Bull flag, you can argue, but almost losing the support range right there. We will see if Consumer Defensives is able to catch a bid with the growth unwind or not. If we don't, we're coming right back down here, 78.29 to 76.35, which has also been an area where when times get fearful, such as tariffs or such as the early January sell-off, when it was really not going too well, I wouldn't mind buying or positioning on some of the names in Consumer Defensives, prior resistance highs, current support lows. That will be the area. And look at Costco. Costco's been coming down now for like 2 months, coming to the 12 EMA. Not a bad bet down here, guys. 920 to 870 roughly. I wouldn't mind adding a few shares of Costco to the long term. And also Walmart. Walmart's been doing a lot of nothing, but if the whole market unwinds and drags them down, they've been doing good while the market's been unwinding. But if they come back down to the infamous 93 to 90 area, maybe I might consider positioning in this one as well. Utilities, which has been a big winner recently, guys. Sadly, not doing too much on the Friday. Daily uptrend is still within their control, though. In the event we unwind a little bit and set up the daily downtrend, you guys know the drill. Well, we just might be heading into weekly consolidation. I'd be surprised, though, because utilities might just catch a bid with these further rate declines, knowing that the Fed is going to cut rates. They kind of priced rates in pretty fast there on Friday, but I digress. Very fast-paced movement right here, looking for a higher low as soon as we do consolidate. Real estate as well, they came down on the Friday session a lot, right? In spite of the rate cut, in spite of the rates that were, tentatively going to be cut in September. But still, if your thesis is for a recovery of the housing market come 2026 and 2027, real estate is not a bad bet. It's going to be a slow bet, and you need a few things to manifest, right? Number one, you need a turning of the housing market. Now the housing market is very weak. But now's the time to position. You know you're going into a rate cutting cycle. You know that the consumer is probably going to be searching. There's a lot of pent up demand for homes, guys. In the past few years, people just haven't been buying because the rates have just been too darn high. That being said, not a bad time to position in real estate. Talking about the home builders, such as, let's say, XHB, not a bad time to position. It's been like, 9 months of downside. We're finally starting to see some life. Or other real estate associated plays. Not a bad time to consider these sectors overall. Talking about the VIX, we knew this as well, right? We knew that eventually there was going to be one catalyst to bring up the VIX. You just weren't sure what it was going to be. Was it going to be CPI? Was it going to be PCE? Was it going to be jobs? Turns out it was going to be jobs. So all of you guys that had some buy orders here, playing UVXY and stuff like that, well, you can maybe consider starting to wind some call positions down or keeping some trailing stops on your orders. The next area that the VIX can head into is easily the mid-20s. That is usually when the narrative hits peak fear. We had a very nice rally on the Friday session, 21%. The jobs report caught everybody off guard. But I'll remind you, that is catching everybody off guard. As we move through the narrative, guys, the VIX can drop, but the markets can still drop too, right? The VIX is uncertainty and also velocity, right? If the markets keep dropping, but the volatility, like it's a smooth, if the markets don't drop like during tariffs, like every day, like 5, 6, 7%, right? Then the VIX is not going to go exponentially higher, right? It may peak in the next few days. And then even though the SPY and QQQ can keep dropping slowly as we unwind positions from retail, well, the VIX may find a local top, right? So that being said, now is going to be a great time if you're looking to sell options, guys. Benefiting from high VIX, you get further strike prices. So now you can do some really good work if you're trading the wheel strategy. On to the dollar actually fell in the Friday session as a response to yields overall, but the dollar actually recovered over $100. This one, there's just so many moving parts, guys. The tariffs, the yields, you know, demand for the dollar abroad, stuff like that, right? So the dollar still relatively weak. It did fall back a little bit here, but nice weekly uptrend attempt, change in the trend attempt by the bulls, right? Not too bad right there. So everything not looking too bad. Pay attention to the MACD. Also not looking too bad. And you did see a couple pullbacks here, big pullbacks on several currencies that have been running hot, such as the euro, such as the pound. So this is going to be an ongoing developing story. But one thing clearly has changed here, especially you look at the pound, right? They unwound. Clear unwind here. You may just find some repositioning into the dollar and dollar denominated assets. If the expectation is that yields are going to be cut sooner than later, maybe you might see some last minute positioning. People are rushing to lock in some of these longer term yields before they might decline, because I think now it's kind of cemented in people's minds that you will be falling. So at least maybe the bonds have kind of found their temporary floor right there, because as I've always said on the channel for the past month that we've been analyzing these, right? Overall, guys, right, you got to keep in mind, the only reason that the bonds died when Jerome Powell cut rates last September is because they didn't believe he was doing it in good faith. He was doing it when the economy was still doing fine. As a result, the bond traders called his bluff and said, no. You're not going to do that. You're not going to cut rates when the economy is still fine and inflation is still a concern. We don't believe you. So they unwound this entire trade. Now that the Fed will be cutting into a weak labor market, well, now there's reason to be doing so. So now your longer term yield traders will start positioning in some of the longer term bonds. It just makes perfect sense, right? That being said, moving on to gold. Gold is up for analysis as well. So we were talking about gold being the uncertainty trade, and you know, the bull showed up in a very big way on the Friday session. If there would have been no uncertainty, gold would have continued to unwind following the same pattern of, you know, very flat price action that we've been having over the past 3 months, since the data has largely been good, right? So this is kind of like the VIX, essentially, right? Bring back the uncertainty. Gold is now the uncertainty trade. So people positioning from equities back to gold, and you're looking for a nice little move by the bulls right here, coming into resistance 34 down to roughly 33.67. We will be looking for a recapture of the daily uptrend eventually, and possibly some motion here trying to establish a new weekly uptrend. You would need a break above 34.31. Not bad though. If you want to position now, the stop loss would clearly go below under here, and your take profit would be right around your all-time highs around 35. So it's not the best risk to reward because that candle on Friday moved very fast, but the trade does make sense if we were to move through a bit of weak equity seasonality and give gold an extra little push, never closing the weekly below the 12. This was the do or die area. They saved it on the Friday, so you might just be looking for a further push. Not looking too bad. Now moving into Bitcoin. So Bitcoin obviously coming down on the Friday session and even on the Saturday session that just closed a few hours ago when I was filming. So one thing is clear, guys, we lost our area of support. Very clear loss. It started on Thursday and I was saying, watch out. You know, if a clear candle closed below here, first time in like a month, pay attention to it. Daily downtrend, but have no fear. Even if we do set a lower high into lower low, the bulls are working with a ton of space, guys, a ton of space. Sorry, all these boxes should be green, but I was kind of doing a technical analysis course earlier, and the box color was not of importance, but I will change the green just so you guys know what I mean. Prior all-time high resistance, prior resistance here. The chop zone will be newfound support for the bulls. Anything above 98,000 looking for a weekly high or low for possible further trend continuation. And even if even if you unwind this over the next few weeks with the narrative, do you have room on the monthly? Well, let me ask you, anything above 74.5 is looking for a monthly higher low. So even if you crack this level and head back down to the 12 EMA, a location that the bulls have infamously tested a few times over the past year and a half, would it be a buy? Most likely, guys, coming down there. First stop, 110 down to 100. Second stop, 95 down to roughly 90 zone. So I will be a net buyer on Bitcoin across these two areas, buying decently here, but saving some room if ever you drop to the lower level. So please keep that in mind. That's just how I'm playing Bitcoin. Now moving into the rest of the market here, we're going to start off with our big tech names, and we're going to start off with Apple. So Apple on the Friday session down 2.5%. Unfortunately, once again, getting rejected at resistance, and that is in spite of having very good earnings. 221 to 213 still remains the biggest area of congestion for the Apple bulls, but we are coming back down into a zone that I like very much, a zone for possible short puts. I enjoy short puts under 200. I think that their earnings are pretty good. We reviewed them on the channel on Thursday. Make sure you go check that video out if you didn't have a chance to. But of course, the price action is very clear. So we'll be looking for the bulls to kind of play some defense in the area that they have played defense for a very long time at this point. I will gladly sell some short puts on Apple and maybe even load up a few shares. I think the risk reward on Apple is pretty attractive right now, all things considered, being the fact that, you know, they showed one of their best quarters that they've had recently. So building some swing trade positions here, we know that Apple's been lagging. I assume that they'll have a very good iPhone 17 rollout, and that their Q3 and Q4 numbers will not be so bad at all. Keep in mind that Apple is still wildly lagging behind the indexes, down about 19% year to date. So if we're carrying positions here into the tail end of 2025 and into 2026, I think we might have a very good shot here at some decent risk to reward action on Apple. On to AMD right now. Look at this weekly candle close on AMD, guys, right? So I'll just put a resistance box here. It's going to be green, but apologies. It is resistance. We were commenting on this. This was a take profit area. Everybody who had calls from either down here or even the midway, I was saying, guys, it's not going to last forever. Now, I do expect AMD to have some pretty good earnings, but, you know, even a company that's great earnings like Meta and Microsoft, which we'll see after, if the market's not conducive to pushing further and higher on the S&P, well, what do you think is going to happen? They might have good earnings, but it might just get sold down. If they have good earnings and they get sold down anyways, well, you guys know the drill, right? Where could we maybe be heading? Sorry, I erased all the boxes. I'll put them back. We might just be heading back down to our most recent area, which would be around the 150 mark. At that point, the bulls will be looking for a clear path right here, looking for a weekly higher low. Anything above 133, looking for a weekly higher low for possible further trend continuation. If you ask me where I want to reposition on AMD, considering we might get some pullbacks, it's going to be down there. But we don't have that much time before earnings, guys, and this company is going to move big on earnings. Expected move is about 8%. They will move big. You move big and higher, you might just clear the 190s. If you don't move higher, even though they have good earnings, you're heading right back down there easily to 150, at which point I would be interested in playing some positions here with the EMAs catching up. Moving on to Amazon right now. Amazon down 8.27%. Yes, we covered their earnings on Thursday. Do they deserve such a drop? Nowhere even close. I will be gladly adding some long-term shares here. And also, as we move into the lower section of further support, 200-day EMA is down there at 205, and the bottom end of the range is 204 down to 196. Clear loss of the daily uptrend, something that has not happened since back here in the early stages of the month, or rather the late stages of the month of June. Daily downtrend, the bulls got it back. We will see, right? If we push into early next week, this whole area sadly becomes resistance again. 228 down to 217 will now be resistance for a back test for the bears, and maybe you get the unwind. Keep in mind though, what is Amazon looking for here on the weekly? Looking for a higher low, anything above 207. And if we give it all back, is it that big of a deal? No, just pay attention to the higher time frames here. Amazon has had 3 and almost 4 very nice months of rallies from the tariff lows. You're looking for a monthly higher low for further trend support and then, or further trend continuation, and you're coming into the 12 EMA. So essentially what I'm saying is, I will be selling Apple puts down here, low 200s, and positioning as well with some shares and maybe even more leap call options if we do come down into the infamous $200 range. Their earnings, in my opinion, were fantastic despite what the media may lead you to believe. We covered them in depth on the channel, so make sure you watch that on Thursday's video. In terms of Google right now, same concept. Unwind of the daily uptrend right here. Daily downtrend is in motion. You know that daily downtrend means you're into a phase of weekly consolidation. That being said, we have support, short-term support, 191 and a 184. But if the bears make very quick work of this because the SPY and the QQQs are weak, you would not be surprised. Anything above 163 at that point, looking for a new weekly higher low, and then you would be probably coming down into this chop zone, into the EMAs as well. If you ask me my opinion, the 180 range is a buy for Google, possibly for two things. Number one, is going to be some short put options. And if you sell down to that region, maybe even up for consideration for some leap call options as well. I already have mine. I got them at 165, but there might just be a second entry if we come down and crack that 180 level again. I think the risk reward on Google is fantastic, and they did have very good earnings. We covered them just about a week ago. On to Meta right now. Meta down another 3%, unwinding some of their fantastic 11% earnings move, but we covered their earnings, and earnings were absolutely fantastic across the board. A blowout quarter for Meta. But price action on the SPY and the QQQ we're not giving further gains, sadly, right? So we know that the bulls create a lot of space right here. Anything above 691 will be looking for a new higher low for possible further trend continuation. And we are looking at this area right here, 733. 733 is prior all-time highs. It's the area of congestion right there. So pay attention to how we react from this one. Meta for me right now is not a swing trade, because we know that if the overall markets consolidate, Meta might just get dragged down with the bunch. So it is an area for me to nibble some shares, as I was saying, after their earnings. If we give it all back, and don't be surprised if that's the case. So if you give it all back here, guys, and we fall back into 704 to 675 with these earnings, that's when I'll kind of lean into my buys and maybe even start some swing trades, maybe with some call debit spreads or stuff like that. But for now, I'm going to kind of let the price normalize on Meta. Microsoft, same concept. Amazing earnings, and they gave back almost all of it. Signs that the market was very extended leading into these earnings. And unfortunately, just the news kind of unwinding. So Microsoft has fantastic earnings. That being said, I am still not a buyer. Daily uptrend is still nice, looking for a higher low, but we've given back a lot of this move, guys. A lot of the move. If you end up with the lower high into lower low and lose the 12 and the daily uptrend, I'll remind you, you will be looking for weekly consolidation. Look at this weekly candle, guys. Weekly candle is not looking very conducive to further gains. If you unwind, you're coming down to the 12,486 and the next destination, 470. That will be a big pullback from the top. Talking about 11, 12 to 15% on Microsoft. I'm not saying it's going to happen. I'm just saying if it does happen, that's who will probably find me buying a little bit, as Microsoft's valuation here is quite extended in spite of their massive earnings beat. Moving on to Netflix right now. Netflix just continues to slide, the poster child for a 3-month move coming to an end, and culmination in the loss of the 12 EMA and the setting of a daily downtrend. As you can see, it can last for more than a few days. It can lead to several weeks of consolidation. So pay attention to that when you're looking at indexes and other names who have also ran this much, are that extended, and are currently losing their 12 EMAs and their daily uptrends. As of right now, backtesting resistance and all the EMAs, and the bears might just be looking for a little bit of a leg lower. You have one little guy right there at about like 1120 pretty much. The bigger level though is 11. I say 1100 because it's just 1100 flat, right? That being said, the short-term bears are in full control. They control the daily right now. They also control the weekly. This is a weekly unwinding right here, and you're also looking for a monthly higher low. Look at the way they closed the month of July, right? Very extended candle here, and they closed at the low of the candle. So continuation is highly likely, especially if the SPY and the QQQs continue. Continuation on Netflix down is highly likely. And where could we be heading, guys? Possibly $1,100 to $1,000. Join up with the 12 EMA right there. Netflix does this all the time, right? Nice pull up, come to the 12, nice pull up, come to the 12, nice pull up, come to the 12, maybe nice pull up and come back to the 12. I will be buying some more Netflix shares if we come down there. I've been waiting for it for a while. I was calling it here and people said it couldn't happen, that we were late, that we might as well just buy here. It's not how it works, guys. If you're patient and you let the market come to you, you'd be surprised. You can get some re-entries if you just exercise a bit of patience. And if not, there's so many other stocks in the market to buy at any given time, so nobody should ever feel any FOMO on anything. Moving on to NVIDIA right now, 2.33% to the downside. Same thing for NVIDIA. Daily uptrend, but watch. Just watch it, okay? I'm not saying it's going to happen. Just watch it. If they lose this 12 and they come back too low in relation to this guy right here. That's an engulfing move. You open up the door for lower high into lower low. Daily downtrend, first of its kind, a la Netflix, in this weekly candle also doesn't look too conducive to further growth. Matter of fact, when you get some of these candles, it shows that the bulls are a bit exhausted. And if we do come down from an exhausted move higher, where can we maybe come back into? Well, I'll remind you guys, we got a lot of support below. The 12 EMA, excuse me, on the short-term time frame is 155, and then you have the 150 to 145 prior all-time highs. Don't say it can't happen, guys. Anything can happen in the market. So I'll be patient. If we get a quick unwind on NVIDIA down here, I will be looking to buy these dips. I'll just be looking for the 150 handles to possibly buy those dips, cool off a very extended daily RSI right here in which we are seeing clear daily divergence. That's another catalyst right there. So if you come down and you unwind, it would just be also natural for a stock that has done almost nothing but go up every single one of the last 12 weeks. That's just how we can move. And you would just be looking as well for a monthly higher low for further trend continuation. That wouldn't look so awkward, would it? NVIDIA's done it tons of times in the past. Moving on to Tesla right now. So Tesla down about 1.83% overall. Not the best day for Tesla, but this one as well. If you guys think that the SPY and the QQQ are going to embark into weekly consolidation and Tesla is just somehow going to hold the support range, you might be mistaken, right? Tesla will just get dragged down with the rest of them. Daily downturn right now underway, testing the 200 EMA and testing our support box, which is 300 down to 260. Tesla, for me, short term, long term is a different question, but short term, with the earnings that they just had, and obviously the lackluster guidance that we had for the rest of the year, Tesla is probably the last company that I'd be looking for short-term swing trades. It just is what it is. Long-term is a different story, okay? But short-term, probably the last. When you look at the short-term, guys, for these pullbacks, you want companies that have affirmed very strong numbers for the rest of the year. Tesla did not do that. I'm not saying where they're going to be in the next 3 to 5 years. It's a different story. But if you're looking for companies that can recover from a quick pullback in the markets that could last up to a few weeks, Tesla is not front and center on my list because their guidance for the rest of the year was not very good, right? Not as good as the other companies that we just saw, such as Meta, Microsoft, Google, Amazon, stuff like that, yeah? So that being said, guys, Tesla, keep an eye on how we react to this. If you flush 287, that is a weekly downtrend, and you might just be looking for more monthly consolidations, a very wide range right here. The bottom end of the range would not be foreign to test at 260. Moving on to Palantir. Palantir down 2.58, but nothing matters on Palantir. What matters is their earnings on Monday. So no matter what I say could happen on Monday, this stock is going to move 10% up or down, more than likely, right? If you move 10% higher, great. The bulls saved it again. You're moving higher to 170 and you continue the daily uptrend as if nothing happened. If they show great numbers, but suffer the same fate as Amazon or many other companies this quarter, right? If Wall Street's if something is not pleasing to them, they will gladly send this stock down 10% lower, at which point we will readjust and say, sadly, engulfing move could result in lower high, lower low, and just be a consolidation phase for Palantir, maybe with the rest of the markets. The next likely area, anything above 128, going to be looking for a back test maybe of the 12 EMA. We will see, though. None of that matters. I will wait to see earnings, and I'll cover it for you guys on the channel. Moving on to SOFI right now. SOFI down 6%. Look at the way they closed this weekly candle. Not very good. Rejecting from resistance a couple times when they tried it. 24.50 down to 22.43. If you start unwinding a little bit more, you'll just be looking for a weekly higher low. Anything above 12.72. Looking for a weekly higher low. Possibly to regain some strength down here around these guys, 18.17 and the 12 EMA, possibly regaining a little bit of support if the market unwinds. I would be looking for some buys on SOFI myself personally, down in the $18 range. I'm not saying it's going to go there. I'm just saying if it does break down with the rest of the markets and flushes these guys and loses the uptrend that they tried to set, well, weekly consolidation is likely, and you might just be heading down there. Keep that in mind. SOFI is still a fantastic company. We covered their earnings last week, and I will be a buyer down there. But this, I've said it a few times on the channel last week, this was a short-term take profit zone, guys. Easily short-term take profit zone. We'll see what happens. On Uber right now, Uber has earnings coming up this week on the Wednesday session. So no matter what I say in this video, the data will change because this company is notorious to move 6, 7, 8% after their earnings. So we'll see what happens right there. Daily downturn is clear as day. In the event that earnings are good, we might just be able to reclaim this support area. right? And just reset the trend. If earnings are bad, well, where do you think we're heading, guys? We are heading right back down here into $81 to $77. That is where the bulls were able to put a stop, his prior resistance a few times in recent memory, and could just be a location where the bulls find a lot more support. That would be a sell down from the top of 16% or more, something that I would be willing to buy, both for long-term portfolio shares, but maybe with some volatility, play the wheel, selling some put options down here in the high 70s. And lastly, TSM unfortunately down 2.65%. Keep an eye, guys. Almost lost the daily higher low on Friday. Another red day on Monday. That'll do it. No new highs and lower low. That's a daily downtrend. That is a loss of the 12 EMA, something that hasn't happened in 3 months, and a daily downtrend first of its kind since all the way back here in March, right? So keep that in mind, guys. If that does happen, you are just heading into very healthy weekly consolidation, at which point this is your higher low, 206.82. And we might just be heading down to one level, which is the closest one, 220. Under that, you got very large support and the 26 EMA, and that would be 210 down to 200. I'll be a big fan of buying TSM anything under 220 using some short puts as my favorite method, as we just be looking for a very healthy monthly pullback. This wouldn't look so awkward, would it? Monthly higher low for higher highs coming into Q4? Absolutely not. TSM has done this several times, and they've all been buying opportunities. So pay attention to if you do come down there. You know, 220 is not a bad nibble, but where I get interested for some heavier swing trades is like 210 or better. That is everything I had for you guys today for today's video. I just looked at the time, an hour, 28 minutes. Sadly, I cannot do the biggest gainers and losers of the day. We'll have to kind of tackle them on Monday. I know, I apologize. There were many of them, but if I start doing these now, the video is going to be an hour and 40 minutes long. And I think if anybody sees over an hour and a half, they just won't click on it. So we'll do them. We have the time, guys. I mean, what I said here today is applicable to all the stocks on the biggest gainers and losers of the day. Just follow the SPY and the QQQ, right? None of your high-flying growth names such as Coinbase, which had earnings, it showed that transactions were down, not very good report. Roblox, you know what I mean? CoreWeave, Circle, Oklo, the SMRs of the world. Like, none of these companies, if the SPY and QQQ end up in consolidation, none of these companies are just going to blast off as if nothing's happening. They will be unwound. So pay attention to that. Be very patient with these companies, guys. If big tech is going down, small tech, speculative tech is definitely not going to go higher. So be patient. Let the market come to you and let the market establish some lows. We'll talk more about these come the Monday video, of course. And that's all I had for you guys today. So hopefully you enjoyed the video. If you did, consider dropping a like. Would appreciate it for growth of the channel. Consider subscribing if you're new. We do these every Monday to Friday, unless I'm busy and I do them on a Saturday like today. And lastly, but not least, if you have any questions, leave them down below in your comments. I know a lot of you have been commenting, thanking me for, the insights as to take profits. Now you guys are ready for the dip. So let's smash these dips. Let's call the bluff on this narrative, but not go too quickly. Do progressively, wait for the markets to come to you, establish your levels. And when the levels come, hit them, right? Because it's very easy to get caught up in the narrative. Oh, it's going to go so much lower. Just do it progressively, guys. Identify the levels and go shopping, and everything will be just fine. That's all I had for you guys. Take care. Enjoy the rest of your weekend. See you tomorrow for the top 5 options plays, where I'll throw a bunch of names at you. Take care. See you soon. Peace.